Welcome to InvestorHubX.com. Have you ever noticed how price makes a strong move, pauses for a moment, and then continues in the same direction? That pause is not random. It is often a powerful pattern known as a bull flag or a bear flag. In this video, we're going to break down the structure of bull flags and bear flags, how to measure realistic price targets, and look at real market examples so you can recognize them with confidence. These patterns appear again and again in the market, and once you learn to spot them, they can become a powerful tool in your trading. Let's begin. Let's start with a bull flag. A bull flag is a bullish continuation pattern. First, we have this strong upward move. This is known as the flagpole. It represents strong bullish momentum and an established uptrend. After that, price begins to pull back slightly and forms a parallel descending channel. This is the flag. You'll notice that this structure is made up of lower highs and lower lows, connected by two downward sloping trend lines. Now, even though price is moving down in the short term, this is not a reversal. It is actually a bullish consolidation pattern. It shows that the market is simply pausing before the next move. Once price breaks above the flag, it signals that buyers are stepping back in and bullish momentum is likely to continue. This breakout often presents a long trade opportunity. Moving on to the bear flag. A bear flag is a bearish continuation pattern. First, we have this strong downward move. This is known as the flagpole. It represents strong selling pressure and a clear downtrend. After that, price begins to pull back slightly and forms a parallel ascending channel. This is the flag. You'll notice that this structure is made up of higher highs and higher lows, connected by two upward sloping trend lines. Now, even though price is moving up in the short term, this is not a reversal. It is actually a bearish consolidation pattern. It shows that the market is simply pausing before continuing lower. Once price breaks below the flag, it signals that sellers are stepping back in, and bearish momentum is likely to continue. This breakdown often presents a short trade opportunity. You may be wondering, how do we find the price target of a bull flag or a bear flag? It's actually quite simple. Let's use a bull flag as an example. First, identify the flag structure by drawing a parallel channel, connecting the lower highs and lower lows. Next, measure the flagpole, which is the strong upward move before the consolidation. Once you have that, we project the move forward. Take the length of the flagpole and duplicate it from the breakout point of the flag. This gives us a projected price target. The target of the bull flag is typically the point where this measured move ends, which represents a continuation of the original momentum. Now that we understand the structure of bull flags and how to measure the price target, let's take a look at how this actually appears in the real market. This is Bitcoin on the daily time frame. Here we have the flagpole, the strong upward move that shows bullish momentum. After that, price begins to consolidate inside this descending channel, which forms the bull flag. Notice what happens just before the breakout. Price begins to shift its structure. Instead of continuing lower, it starts forming a higher low, followed by a higher high. This is an early sign that buyers are stepping back into the market, and momentum is starting to shift from consolidation to continuation. Entry 1 is here, when price breaks above the channel. This is the more aggressive entry. Entry 2 is here, when price comes back to retest the breakout point. This is the safer entry, as it provides confirmation that the breakout is holding. To measure the target of the bull flag, we take the length of the flagpole and project it from the breakout point. The target of the bull flag is the point where this measured move ends. This is Ethereum on the daily time frame. Here we have the flagpole, the strong downward move that shows bearish momentum. After that, price begins to consolidate inside this ascending channel, which forms the bear flag. Entry 1 is here, when price breaks below the channel. This is the more aggressive entry. Entry 2 is here, when price comes back to retest the breakdown level. This is the safer entry, as it provides confirmation that the breakdown is holding. To measure the target of the bear flag, we take the length of the flagpole and project it from the breakdown point. The target of the bear flag is the point where this measured move ends. Bull flags and bear flags are typical technical analysis patterns. They appear again and again in the market. Once you learn to recognize them, you'll start seeing them everywhere. To summarize, in this lesson, we learned that bull flags and bear flags are continuation patterns. A bull flag forms in an uptrend and breaks higher, while a bear flag forms in a downtrend and breaks lower. We look for breakouts and retests as high probability entries and use the flagpole to project the target. These patterns appear again and again in the market. Once you learn them, you'll start seeing them everywhere. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.